Alright, so we continue now with financial management. This is lecture 12, and we come to answer properly Mario's question from 2 months ago, which is, what determines interest rate? And remember that question when you ask it, and I kind of gave you a quick and dirty 2-minute answer, which is of course no good. Because it requires 2 weeks, not 2 minutes. And we'll spend today and probably 2 or 3 or 4 lectures of interest rates and what determines interest rate. And let's first write out interest rates. That's it. That's the topic for the next 3 or 4 lectures as the most important and fundamental topic in finance. That is Chapter 6. Chapter 6 from the Brigham textbook, page 151. One of the better lectures on the internet on interest rates will be on YouTube on my channel KM Petrov, and it is called that you can just go and just type theory of capital and interest, or interest and capital. All right. Now comes the explanation. And the explanation is amazingly simple. Interest is simply cost of capital. That's it. Cost of capital. Nothing more, nothing less. That's the simplest, easiest definition you'll ever get. Now comes the hardest of all definitions. Capital is probably the hardest and most difficult concepts in finance, simply because it's the most misunderstood, and because most people know the wrong thing about it. And here is the explanation. The pure concept of capital is the same as equity. So one of the very many meanings of capital is that of equity, as in equity capital. So when people say capital, they simply mean equity. They don't mean anything more, they don't mean anything else. Well, if you remember, we talked about capital markets. In a capital market is a market where capital instruments are traded, which simply means long-term instruments. So some people understand equity as long-term funds. Example will be a long-term 10-year bond. That's capital, okay? When they say capital structure, they mean the ratio of debt to equity. So many people simply think in terms of capital as in financing. Financing. So let's try to clarify a little bit more, and let's draw the picture of the balance sheet, okay? And when I draw the picture of the balance sheet, let me use, we got here green color. Okay, let's do the green thing here. You got here equity, and you got here debts, okay? Is in liabilities. And debt is divided into LT standing for long-term debt and ST standing for short-term debt, okay? So, many people think of capital simply as this piece. For many people, this piece here, the equity, this piece here, the equity, is what they think and mean by capital is this piece. When they say capital, they mean this number one. That's all there is to it. Some others think it's not just equity, it's equity and long-term debt. So other people think of equity as two, equity and long-term debt, which we call long-term financing. Long-term financing is long-term debt and equity. Now, others, when they say, the capital of the firm, and basically when they say capital structure, they mean the whole thing, all of liability sides, which we call financing. In financing, in this particular case, we have also used what's called in finance source or sources of financing or finance. Sources of financing. Actually, we like to use, let me delete this, or you can put in here, sources of funds. Funds is what we like to use. Sources of funds. So when people say, now, other people, another businessman, he's got a lot of capital in his business, but they don't mean capital. What they mean is assets. And when we use the green color over here, these are fixed assets. We also call them long-term assets, okay? And these are current. We also call them short-term assets. For many people, what they mean by capital is simply fixed capital. For some of them, they just mean, fixed capital, as in, remember, fixed assets. So what they actually mean is this piece here, number 4, okay? That's what they mean by capital. And this is already sufficiently confusing. Number 5, when they say that, he's got a lot of capital, they simply confuse capital with investments. So they say, he's got a lot of investments. So they think of capital as in investments, as in invested capital, okay? They're just general investments. And many people, when they say capital, they simply confuse it with assets, any asset, all assets. Fixed assets, current assets, other possessions. So they just confuse it with assets, which the correct and proper term in finance and economic is wealth. So, this is the explanation as to why capital is so tricky and so confusing. Because you talk to 5 professors in finance and they're going to think of 3 different definitions, okay? Some people will think of it just, wealth. Others will think it's just investments. Others will think as machines, equipment, land, okay? For example, someone's going to say, I got 20 billion in capital in my company. Well, he means he's got a taxi company and he's got 500 cars, okay? That's what he thinks is his business in terms of the fixed assets, okay? So, different people are very confused as to what exactly is capital. And out of this, now comes even more confusion. You have what they call, and we can call it like that, and that's actually a very good term because it's crystal clear and there is never a confusion. We call it equity capital. And when you say equity capital, it is perfectly clear to anybody that it means one, only one. Uh-oh, blue one, blue color. So, equity capital, there can never be a confusion, it's always a good term. The next one, which they use quite often, I found in the textbook, which is all right, is called debt. Capital. And debt capital will be, now I gotta draw, it's not exactly clear, but it should be this part here. So 1, 2, 3, 4, 5. Okay? This is all the non-equity, all the non-equity, all the debt. So it's going to be 5. Okay? And now, again, I'm trying to explain why this whole feeling is so messy and so confusing. There is a concept of cost of capital. Now, when they say cost of capital, let's clarify what this means. First of all, number 3 here is sources of funds, as in financing. So this piece here, from the very short-term debt, through long-term debt, through equity, this is number 3, okay? This is number 3. And number 3 is sources of funds. So when we say cost of capital, we definitely mean cost of all sources of funds, so becomes equal to 3. Okay? Then you have this concept of cost of money. Which is not, to me, exactly clear what it means, but the way they use money in this particular case is they mean cost of short-term debt. Okay? So when they mean cost of money, they mean cost of money market funds, or cost of short-term borrowing, or cost of short-term debt. So when they mean this piece here, okay? That's the cost of this short-term debt will be cost of money, okay? So, and let's see if I have cost of money, cost of debt, cost of equity, cost of capital, and again, all of this would represent interest. So, let me repeat again. Interest will be basically return on equity. Interest could be return on debt. Interest could be considered return on long-term debt, as in bonds. Interest could be on short-term debt, as in commercial and other paper. And interest could be just return on any capital or all capital, all sources of funds, okay? So interest means a lot of things, but the general idea is that of capital. For us in finance, we like to think of capital mostly as equity, Others like to think of capital as funds at risk. So if it's at risk, so you can add number here, 7, funds at risk. That's a very, very common way to think. And again, what I'm trying to tell you here and explain to you is that that's why the whole subject is extremely confusing, okay? And the solution to this major confusion is very simple. Because you got so many meanings of capital, what you need is a theory of capital. If you have a theory of capital to understand what capital means, interest here with the letter T becomes fairly easy and becomes fairly simple. And that's one approach, okay? Now, they here tell in section 6.1 cost of money, okay? Whatever that means. Cost of debt, I don't know. So, let's try and see what the essence is. And the essence is, basically, you have 3 sections which are answering a question, which is the factors which determine interest. The factors which determine interest rate, right? You're not exactly interested in the theory of capital. You're interested to know what determines interest rate. Are they going to go up or are they going to go down, right? Why interest rates in some European countries are high, in other European countries are low, and why they're lowest in Japan, okay? And why they're high in Argentina, okay? Or in Vietnam, they're actually very high interest rates, and they're relatively high in Bulgaria, but not as higher as Vietnam. So, factor number 1, production opportunities. Production opportunity is what it means. Do you have good investments or you don't have good investments? Are investments productive or not productive? Can you get a good high return on your investments or not? And the answer is now the most profitable investments are somewhere in Vietnam. And Vietnam offers very high return on investments, very high production opportunities, and therefore you'd expect interest rates in Vietnam to be significantly higher than, say, in other countries, okay? So, if you have good, profitable investment opportunities and people are willing to borrow to finance those opportunities, certainly you're going to be having very high opportunities. Now, getting back to the factors and coming up next week, far into the end of the lecture, the opposite example. If the economy is in a terrible recession, as the US is right now, or as Japan is right now, and you don't have any productive opportunities, you don't have good investment opportunities, people won't be borrowing, and if they won't be borrowing, interest rates will be low, okay? So, production opportunities depend on the state of the economy. If the economy is strong, booming, vibrant, okay, it will have a lot of opportunities which will drive interest rates up. If the economy is in recession or in depression, it won't have any opportunity. I mean, why invest in any real estate? I mean, you already got plenty of real estate and prices are crashing. Anyway, you don't want to invest in that. You don't want to invest in cars in the United States, okay? You want to invest in countries like Vietnam where cost of labor is relatively low, where input to output ratio is high and profitability is high because cost of input is low and the prices are global, okay? If you can produce some agricultural commodity there at a much cheaper land and much cheaper labor, your profit opportunities will be higher and you'd expect there to have relatively good high interest rates. And that's the production opportunities. Question?
But when the economy is in a recession,
yes,
which means the risk increase.
Yes, that's a separate issue altogether. Correct. If the economy is in recession, risk increases. And if risk increases, people don't want to invest. They don't want, risk goes, affects demand for investments. Correct. Risk goes up. So if it gets riskier, why invest? And the answer is, you don't want to invest. Okay, what's the question now?
But when risk increase,
Okay.
which means the interest rate should increase.
Oh, okay, well, if risk increases, interest rates should increase. Yes, true and false. I will be explaining this in the next lecture. Not necessary. When risk increases, interest rate don't increase. Compensation for risk increases. Okay? But the interest rate might not increase. In other words, what we're going to get in the next lecture is, let me write it out and let me find it over here for you, is this one on page 157. Let's write it out quickly. Interest rate is equal to, let's call it RRF, which is RRF, which is the risk-free interest rate, okay? And then you have the premium for default risk premium, liquidity premium, and what other premiums they have? MR, yeah, inflation, let's call it purchasing power, or inflation premium, or purchasing power premium. So, what is true is that the default risk premium will rise, very correct. The liquidity risk premium is also likely to rise, but in a weak economy, this will certainly fall, and the inflation premium may possibly fall because inflation pressures during recession, usually prices don't rise as much. Now the central bank tries to counter is a whole different story, I'll get into it. But the answer is the compensation for risk increases. We'll call it the risk premium increases, but not necessarily the interest rate. What may actually happen is the opposite. The overall interest rates may fall a lot more than the increase in premium can rise, okay? So that's another discussion separate. Now we're just trying to get the pure factors and we're going to get to all of them. That's why I'm saying is this topic is complicated where we can't do it in 1 hour. We need 4 hours to cover this properly. That's what I'm planning on doing. So number 2 is called time preferences. And time preferences refer to consumers. As in savers. Well, time preferences depend on the state of the economy, but the most important factor in preference to save versus consume is actually culture. Asian cultures are a lot more oriented towards savings, and Western culture is oriented towards consumption and consumerism, okay? So Western economies like US and Europe have very low savings rates. So this will be determining the savings rates. Savings rate. Are you saving a lot? Are you saving? So which cultures save a lot? Well, Chinese save an awful lot of money. One of the highest savings rate in the world until recently was Japan. The Japanese save an awful lot of money too. Now, which is a culture with extremely low savings rate? Well, the lowest saving rate in the world is USA. They just consume. They never save. They don't save. Well, I mean, you can explain it with economics, but it's best to explain it with culture. This is who the people are. This is what their mentality is. It's culture of consumerism. It's culture of debt. It's okay to spend money. It's okay to spend money you don't have. I mean, what's the problem? Again, of course there's a problem spending money you don't have, but in their culture, there's no problem with it. It's okay, all right? So, culture determines, and of course the economy determines. The economy is good, the economy is strong, jobs are everywhere. Oh, you know, there are going to be more universities opened, I'm going to have a lot of money. If I'm going to be making a lot of money, I don't need to save much, right? I can spend more. I can buy that Apple computer and I can buy that iPhone, right? Sure, why not? If I'm going to be expecting a lot. On the other hand, if the economy is in trouble, there is a recession right around the corner, hard times are here, I might say, I'd better save my money, okay? So, time preferences are about people's desire to save. And it depends on the culture, and it depends on the time. In good times, people prefer to spend because they expect a lot more money coming. In hard times, they say, well, I don't know what's going to happen. I might lose my job tomorrow. I'd better not spend. So, these are some of the key determinants. Let's see more. Number 3, risk. And that risk runs according to the risk here, the risk in the liability. Short-term liabilities are usually relatively low risk. The bulk of risk is absorbed by the capital itself. Capital bears the biggest risk. The long-term debt bears the risk. So as you move from the bottom, risk lowers. As you move from the top down, risk increases. So depending on the kind of capital you're talking about, are you talking about equity capital or debt capital? The overall capital, again, short-term, long-term, security. So risk is a key determinant. In general, when a project is risky, people will not be willing to invest in it unless it provides higher return. So risk is a completely independent component, and what you were saying is separate. The economy, the state of the economy determines both the production opportunities and determines risk and determines time preferences, okay? And the last piece which we have as a separate factor here is inflation. And inflation, again, refers to the purchasing power of money. Interest rate, let's call them nominal interest rates. Nominal interest rates are determined by real interest rates and a compensation for inflation. So we can say then, let me use green color, is that these are the main determinants of real interest rates, and this one is the component for nominal interest rate. So these here are real interest rates, and this one is the component for nominal interest rate. You add this component to real, in other words, you add the inflation component, and you get nominal. So, nominal interest rates incorporate inflation too. And this is the way it looks to me. This is the way it looks to me as the key, and that's basically section 6.1. And I was thinking, of course, I can do 6.2.3.4, but I think that's good enough as a starter. for the next time you should prepare as a beginning to interest. And next time you should prepare a little bit of 6.2, 6.3, 6.4, 6.5. In other words, we got a full chapter to cover for next time. 6.6 we're gonna skip, and we're gonna go then to 6.7, which are the macroeconomic factors that determine interest rates. In other words, which are the macro factors that determine production opportunities and time preferences and risk and inflation. So we're going to spend the next 3 lectures talking a lot more about this. But this is the basics, okay? There's going to be a lot more coming. Okay? Good enough?